Hello everyone, as promised in one of my YouTube shorts that I posted earlier here about the economics part, I will walk you through those tasks that I mentioned there step by step with solutions and explaining how to approach them using the economics book that WU provides. First, we will start with an easy task I made ages ago in 2021 that is used as warm-up. It's pretty easy and simple. Then I will show you the same concept, so supply and demand, but on an exam-based task with 5 true-false statements to show you how scenario tasks could look like. Then I will show you a task I made in 2022 based on the theory concepts from the book. So you will also have a few of those where you just need to learn the definitions by heart and also what is what. And then we will have two calculating tasks. So one of them is going to be an accounting-based task with accounting ratios. And even though I made it 3 years ago, it is still more difficult than the 2025 entrance exam task, as my students told me, because of course they solve the task. Then they take the entrance exam and really make sure to kind of equal out the stress. So what I do is on the entrance exam tasks, you usually have some kind of one financial statement, be it cash flow, be it a balance sheet, be it an income statement. So it's just one, and then you have questions about it. In this task, I put two financial statements next to each other, and in one of them, I left specific gaps, so like empty spaces that you don't have given to you here in the task that I made, but on the exam, you always have it fully completed, like without any empty spaces. But I just want to make sure, because right now when you're solving the tasks, you're not as worried, you're not as stressed because you're at home, you don't have people around you, it's pretty nice. But on the exam, you will be surrounded by so many more applicants that are taking the exam on the same day. You'll feel the stress and the pressure there. So I make sure that the time that you use to solve a more difficult task will equal itself out with the relatively easier task, but under the stressful conditions. And then last but not least, I will cover an updated task from 2025/2026. That is about ratios in share prices. So in the economics book, whatever they give you, a formula in the brackets or in a formula box, they can ask. That is why I will cover an example task with a table and some share ratios that you need to know by heart how to calculate, and also need to know how to interpret. So without further ado, let's get started, and now we will switch back to the explanation part of this video. And now this brings us to the explanation part of this video, where I will tell you how to solve these tasks. So the first task we start off with is rather simple. I mean, years ago, this was a warm-up task for students to keep practicing the simple things first. And here you have the laws of supply and demand. So this is a concept you have to be really familiar with, because they can give you a scenario-based task of a company or of a product, and you should know the theory so well you can apply it to any scenario that they give you. So for example, here we have if demand would decrease due to changes in income, the demand curve would shift to the left or shift to the right, and you have to choose which one you would say is true. And here, the way you judge this is you have new demand. This is a shift to the left of the curve. And this kind of shift, so this is the price, this is the quantity axis, would indicate that for the same price as before, let's say this is around 20 euros, for example. For this price, people were buying 10 of something. And then when demand decreased, for the same price, people will buy less. Let's say they buy 8 of that something. So that's how you can see that demand has decreased, and therefore it is indicated by the shift to the left of the demand curve. Ta-da. Now we go to the exam style question, where you have a question of 5 statements to that question. You have a scenario. Here we have imagining a housing market where you have people who buy the houses and people who build the houses. So you have the supply side and the demand side. And then you have some scenarios with tax and subsidies. And it wasn't explicitly mentioned in the book as a separate case. But when you understand that the tax kind of subtracts what the person has, and a subsidy gives more money to the person, either to the builder or to the customer, you then can understand what those changes would mean. Let's say if you subsidize the builders, you will increase supply, because then they have more money to build the houses, so they will build more. If you tax a person's income who wants to buy the house, the demand will decrease, because then a person doesn't have that much money to spend. So this is the idea. So even though it wasn't explicitly stated, it's still part of supply and demand, can still be asked, because once you understand the principle of it, is just shifting the demand curves and the supply curves left and right. So here, when the builder's income from building houses is heavily taxed, the price of the houses decreases. So here we can again draw the supply and demand. This helps a lot for these tasks, like the graphs. So either you know the theory quite well and you don't need to draw the graph, but for the explanation purposes, I will still do. This is supply, this is your price, this is your quantity. And here we say, okay, we tax the builder's income. So we basically decrease supply. This will mean that we decrease supply because now they kind of have less incentives and they have less money to, well, to build, so to say, in very, very simple and simplified terms in how economics works. And then here, the price of the houses will decrease. So let's see what happens to the price of the houses. Let me pick a different color. So this is the price curve. And the old supply, so this is new supply after the tax. The old supply for the price of, let's say, 20,000 euros, they were supplying 5 houses. I mean, this is unrealistic numbers, I know, but just for the sake of this exercise. And now for 20,000 euros, they are only willing to supply 3 houses. So the price to get the same 5 houses as before, if you want to keep the same quantity for those 5 houses, has decreased quite a lot. Has increased quite a lot, because here you see that for 5 houses, if you want to keep the quantity the same, so here it's either you look at the price changes relative to price, the same price but new curves, or quantity. So same quantity and you look at different curves. It's both upwards are fine. And here you can see that for 5 houses, you will now pay not 20,000, but let's say 40,000. So to equal out the heavily taxed income, they will just raise the price of houses. So the price of the house will increase, therefore the statement is false. Then you have the supply side. So when the tax on people's income increases. So now it's not the supply curve that's changing, it's the demand curve that's changing, and it changes to the left. It goes to the left because it decreases. So here, I think it's just easier to draw a new graph, honestly, than to erase what I've drawn. And we all know how it goes. So price and quantity. Here we tax people's income, so we decrease demand. So this is what we do. And then, so there's still the same supply. So there's still how many houses or 20 houses on the market, but now people have less money to spend. And therefore, the logical thing to do from the supplier side would be to decrease the price. So here you can say, okay, if everything stays the same, we now have for this price. So before people were buying, I don't know, 10 houses, now they buy 8. And quantity-wise, if you look from the quantity perspective, in the kind of other direction, so to say, here. So here you have, let's say, 15 houses. And before people were willing to pay 50,000. This is the random numbers, I know. And now with the new demand that's decreased, people are gonna pay less. So the price will eventually decrease. Let's say they're paying 30,000 now. So this is the price perspective, this is the quantity perspective, and both ways work. Like to explain or to argue a task, to say if it's true or false. Also, economics is just about if a good becomes more expensive, less people buy it. If a good is cheaper, more people buy it. Honestly, that's all it is. Like most things in the economics make sense like that. So when you keep in mind people are relatively rational creatures, of course, it's not always the case, right? Because sometimes you have goods that are super expensive, but because they're super expensive and they're seen as unique, more people buy them. So of course, these cases exist in real life as well. But in general, people are after what's best for them in economic terms. So yeah, higher price, less demand, lower price, more demand. Pretty simple. Also, when demand is subsidized, so people receive money from the government to spend it on houses. So you now increase demand. So government intervenes and says, and they basically push the demand curve to the right. Then the price of the house increases. So even without drawing the graph, what you should think about, okay, there is still the same supply of houses, but now people want much more of them. And the way to balance this would be from the supplier side to increase the price so that they can kind of keep up with demand and to lower demand a bit in the long run, right? So you increase the price by a lot so people can spend more. You say, okay, to not kind of have this shortage issue where we have like 50 people want to buy and have only 10 houses, you increase the price, so you lower the demand in this way. So just without even drawing the graph, you can say, okay, if demand is now subsidized, the price will, yes, it will increase for the houses. So this is true. The way you do it on a graph is you would draw supply, and then the demand goes up. Because of the subsidy from the government. And here, to buy the same amount of houses, let's say 15 houses, you before were paying this much, say 10K, and now are paying this much, let's say 30K. So the price increases. And this price is quantity. Of course, you don't have to draw this kind of graphs every time you have a statement on the exam, so you should be very familiar with this concept, not to have to do it each time, but I'm doing it to explain to you so you get more familiar with it, right? And then you have the opposite scenario when supply is subsidized. So when supply is subsidized, yes, the supply curve will shift to the right because now you will have more supply. So for the same price as before, I will just draw it like this quickly. So here, for the same price as before, they will be willing to supply more houses because they got subsidized, because they have the money from the government. So here, for the price of 20K, before you had 10 houses, now you have 20 houses, for example. So it's a shift to the right. Then, when supply is subsidized, the price of the house increases. Here we have the scenario where you have more houses now, but people still have the same demand. They don't need as many houses as you're offering them. So the way to get rid of the houses is to lower the price. This would be the idea. So it will be false because the price will decrease. This is the logic behind it, and you can also draw the graph if you want. And you will get price, quantity, demand, supply. So you subsidize supply, so you get a new supply curve. That's increases supply, but then the price will decrease because let's say to buy the same amount of houses here, let's say 10 houses, before you were paying this much, let's say 50,000. Yeah, this is just random numbers just for illustration purposes. And now you're paying 20,000. So the price has dropped, not increased. So yeah, hopefully now supply and demand curves are more like easier for you. That's my mission here for this video, to teach you some of the economic concepts that you will need. And here you can have questions just from the book. So for example, this question is just a theoretical question from the statements and little details from the paragraphs that you have that you might not even be paying attention too much to, but hey, they can ask it. The only thing that they cannot ask are Teen and Steve examples because those are just for illustration purposes of how, just like a storytelling of how the business would work. And then also ATS example company, like the company example with the balance sheets and who does what, it's also irrelevant. So here we say, okay, about 99% of all businesses are small or medium-sized businesses. And even if you forget something from the book, let's turn on logic. A lot of companies in most economies would be either small or medium. Of course, you have a few giants, let's say in Austria's Red Bull, one of the bigger companies, so to say. But most of the companies will be small or medium. And therefore, this statement, even if you forget from the book, it's actually true from the book. It's stated right there in the sentence. You have to say, okay, it's more likely to be true than not to be true. So you still pick it as true. And then non-profit organizations do not make profits. In the book, there's a sentence that say that any profit that they make will go towards the organization itself and like towards nice causes. So with a sentence where they say that any profit an NGO makes goes towards something nice, it implies that it can make a profit. So therefore, this would be false. So also when you're reading something, make sure you understand it, because the sentence doesn't say exactly that NPOs can make a profit. It says that any profits that they can make goes towards the charity causes or whatever it is. So yeah, that's how you determine the answer to this would be false. Then gross domestic product, so GDP, is the total value of all finished goods and services produced by country's citizens in the given financial year, irrespective of their location. So first of all, this is just this is kind of starts nicely. This kind of is like true, but then you have country citizens and irrespective of location, and GDP is tied directly to the location. So whatever is produced in Austria, no matter where the person is from originally, will go towards Austrian GDP. So because of this last statement, especially, this is for sure false. Then an international business has the longest supply chain. Yes, okay, this is from the book, there is a sentence that says that, but also logically, if you have international business, of course, it will have a longer supply chain compared to national business. Yeah, I would say that would be for sure true, like there's no need to explain further. And then if a German company produces and sells goods in Austria, it will be counted towards Austrian GDP. Yes. So any company from any part of the world, if it is in Austria and it produces and sells goods in Austria, it will be, by definition, what the GDP is, counted towards Austrian GDP. So yeah, this is an example of a theoretical task where you just need to remember the book to say, and this kind of task shouldn't take you too long. So imagine you have, let's say, 7 theoretical questions and then 3 calculating questions with share prices, with accounting statements, and so on and so forth. The theoretical statements, if you wake up in the middle of the night at 3 a.m., right, you should be able to solve all the theoretical statements in like 15 minutes. Like this shouldn't take you long, because you would need the time that you can save for the counting tasks and also for the math tasks. So that's why learning the book that WU provides is, well, the key here, so to say. Then here we have an accounting-based task where you have statement of profit and loss and also balance sheet. Also, I make these tasks when I make them a bit harder, because I know that on the exam you will have the stress and pressure. And here, when you're solving them at home, right, drinking some tea maybe, it's not as stressful as it is on the exam. And of course, you cannot replicate the stress and pressure in your room at your house. But what I can do is I can make the tasks a bit more challenging, so it will equal out the time and the effort that you need for a slightly easier task on the actual exam when you have all the people around. So that's why when I was making this task, I left out the blanks for the gross profit and EBIT. It's a little step. It's pretty easy how to get there, but just to take a bit of more of your time, so it kind of equals out the exam, the time that you will be having on the exam to solve them, and with the stress and stuff. So here you have the profit and loss and balance sheet. Also, usually on the exam, they only give you one financial statement. They give you just the cash flow or just the balance sheet or just the P&L. But again, since we're making the task more difficult, that's what I did. So enjoy, so to say. And we will solve it together. So here you have 5 statements about it. You have profits, like the profit share of the revenue. You have ratios, you have their interpretation. And when you're doing the accounting chapter, it's chapter 6 in the book. Don't dedicate the same amount of time as you would do for the first chapter, because the first chapter in the book is super easy. It's just what the government is, what the business is, how to kind of manage it. And that shouldn't take too long. But chapter 6, even though it's more or less the same length as the previous chapters, you need more time for it, because with each ratio that you have, you should also be able to interpret it and to see what it means. If it's large or small, what it means for the company, and so on and so forth. So here, we're interested in the profit share of the revenue, because of course a company can make a lot of money, but if it has a lot of costs, the profits are not high. And of course, with industries, it will be different. An online business will have a higher profit share compared to a construction business that has a lot of costs. So it's normal. You should compare companies within industries and not with like random companies from different fields, because then it doesn't make a nice comparison. It just confuses people more. And for these tasks, I can make them also by hand here, but just to save a bit of time and so you can see a clear explanation, I will show you what I've written out for the solutions part. So here, first of all, let's fill out the the balance sheet and the P&L. To go from revenue to gross profit, you just subtract the COGS, so cost of goods sold. And also, please, in the book, there's a definition of what it is and what it can and cannot include. You should also know that. So here you have the gross profit. Then after the gross profit, you subtract the distribution and the admin costs that are there. They're not directly related to a particular good that you produce, but they still have to be like, let's say, imagine an accountant, you will have to pay them anyway, no matter how many goods you produce, and you cannot really dedicate an accountant's cost to a particular pen or pencil that you sell. So it goes in the admin costs. And then after that, you have the EBIT. It's a very popular profit measure that's used in most cases for most ratios. If you Google some of these ratios, you will have sometimes EBITDA, so with the before depreciation and amortization, sometimes it's EBIT. Just stick to the ones in the book, because sometimes there's slightly different ways to calculate it, but they will only ask you based on the book, so just stick to what the book tells you. And then you have, after the EBIT, you can also get to the profit at the end of the year. So after subtracting the finance costs and income taxes, so well, the interest and the taxes, because this is before interest and taxes, and then you subtract those, you get the profit. And EBIT is a better profit measure because finance costs and income taxes are going to be there irrespective of how well you manage a company with what you have and what you make. So that's why EBIT is usually used in the ratios, because income taxes are just going to, they don't indicate how well your company does. It's just a cost that's always there. It's a formality, right? So yeah, this is how we fill out the balance sheet and, profit and loss statement. And then here you have the statement that's profit over the year is more than 11% of the revenue. Is it true or not? So you just take the profit that you got and you divide it by the revenue that you had at the very beginning of the statement, of the financial statement. And you get that slightly more than 11%, so that's true. And to argue whether it's a good percentage or not, you have to look at the companies within the industry and not at different companies from different industries, as I've mentioned before. Also, return on equity. So some ratios actually have the formula in their name, return on equity. So the profit measure, EBIT, that we take, divide by equity. So what you earn, divide by how much you invested in the company, so to say. And yeah, here you have the EBIT that we calculated. And then the equity we get from the balance sheet. I will do it like this, so that we see both at the same time. And here what you have to keep in mind is, of course, this is obviously equity, for sure. But what is also equity is retained earnings of the company, because when a company makes money, pays everything that it has to pay, and then keeps the money within the company, it is the company's equity. It's internal equity. It's what the company makes. So both of this will be counted towards equity. And this would be liabilities. Once you know that, you say, okay, you divide the EBIT by the share capital plus retained earnings, and then you get 40, like, and you get the number that's not 45.26. Honestly, I don't remember exactly the value of it, but basically what when I was doing the statement here, what I wanted you to kind of see and not make a mistake in is if you don't count retained earnings. So sometimes the statements will be made in a way that if you make one small mistake that you're likely to make, let's say, or they think that you're likely to make, you will select the statement as true when it's not true. So here, if you make the mistake of not adding the retained earnings, you will get an answer that you will think it's true. But you need to know the theory so well that you don't make these mistakes, and you say, okay, yeah, this is false, because I know that retained earnings are also part of equity. Then return on capital employed. Here you can see the statements C and D are interconnected, because once you find capital employed, you can also find this. And therefore, by solving, by putting in a bit more effort here, you can also solve statement C pretty easily, because you capital employed anyway. And then EBIT stays the same. It's from the previous ratio. This one is this number. And capital employed by definition is current, it's the assets minus current liabilities. And then you say, okay, I'll look at the balance sheet. Here you have the total assets. And the current liabilities would be, of course, short-term bank loan, right? This is pretty straightforward. But also accounts payables or trade credit. What this is a short-term. What this means is accounts payables is what you have. Actually, let me explain these two to you. Accounts payables. A company gives you, let's say, 20 codes for you to sell. And you don't pay them back immediately because you don't have the money yet to pay them back. But once you sell the 20 codes that they give you for kind of essentially without a charge now, you can pay them the money later. So this will be a trade credit to get the goods. Don't pay for them immediately, but you wait until the end of the year to pay the company back. And that's why it's also a short-term liability, because usually the company just gives you the trade credit for 1 year. They don't give you like 20 codes to pay back in 5 years. It doesn't make sense for them. And accounts receivables would be a current asset, so a short-term asset. So this is what other companies owe you. This is what you should receive. So let's say you gave the company 20 jackets and they're selling them, and you're supposed to receive the money later. This is a current asset. So this is what you receive. So it's an asset from your side. This is what you have to pay back. So it's a liability on your side. So here, you subtract the short-term liability, like the short-term bank loan and the accounts payables from the assets that you have. And that's how you get the capital employed. And after you get capital employed, you just plug it into the formula right here, the EBIT divided by capital employed, and you get 14.62%. So both of the statements are true. Then the last one. So here's some more theoretical question. With the information that you have here in this task, it is not possible to calculate the asset turnover. Also, fun fact, sometimes the book has words that are not explicitly defined, but if you kind of scroll through the book and try to match the numbers from the examples and from the financial statements, you will see that turnover, when they mention turnover in the book, they are referring to the revenue. And here's the page that you can look at it up. So here, you know that asset turnover would include average net assets. For average assets, you need 2 years. You cannot have one because average, yeah, between the two. That's why, since you only have the balance sheet for 1 year here, because we only give you one, you cannot get the asset turnover. And here I will just press the solution because, well, I just explained it there. So it doesn't matter because we just did it like that from the solutions, because it has a lot of numbers and it will take a bit too much time to write them out by hand. Now, the last question for today's video would be the share prices, because they were quite popular in 2025 as per feedback of my students who got in. And that's why I'm also adding this kind of tasks to the course. And also I'm showing it to you here so that you're aware that there are different formats, different things that they can ask. And also, if in 1 year they were asking a lot of accounting questions, it doesn't mean that they will also ask a lot of accounting questions in the next year, because of course they changed up. But you still have to know everything, right? So yeah. So here you have the books, and in the book you have the company ETNS. It's actually a real company. It's publicly traded. And here you have some key share figures that I actually took from the reports of the company. It exists. You can look it up. You can also find everything that I have here. So here you have the key share figures. And also on the exam, you have just one, right? You have one table. I gave you 2 tables, because it's to make it a bit more challenging. Here I leave out some blanks, as you can see, to make you think a bit more and spend a bit more time, so that on the exam, if it's a bit easier, you solve it even better than now, right? Even faster than now. So here we have some theoretical statements and some ratio statements. So for some of these, you just need to know the theory, what each thing is, and for some, you actually need to calculate. So if the share price changes over the years, or over the months, or over the days, it does not affect the share capital of the company. Here you need to know, once a company sets the share price and issues a certain amount of shares, they're out. The company gets the money, they sell the shares, that's it. The story for the company is done. Whatever profit or loss you get after you sell the share, let's say the share price is increased, you're the shareholder. You can sell the share, you can keep the share, it doesn't matter what you do. The company has gotten the money from you, they give you the rights to sell the share, to own the share, and then it's up to you what you do. So any change in the prices of the share, the company is not affected by it. It's only you as a shareholder who either wants to sell or to keep it who is affected. So yeah, and I will also for these tasks, I would say just keep this as explanation because I also did some comments here. So yeah. So share capital is just, it's always the same actually. If you also look at different years of the company's financial reports, you will see it's exactly the same number. And market capitalization would be different. And we will also discuss it a bit later. So market cap and share capital, please don't confuse the two. They sound very similar, but they're not. So here you have also a quote from the book. If you want to see what I'm referring to, you also have it everywhere. If you're unsure about the term, what share capital is or market capitalization is, just look it up. Watch a short video about it. I also like Investopedia as a website. That's my favorite one for accounting terms, and I also use it during my studies because I have to go to accounting specialization. So yeah, I can recommend that. Then the price earnings ratio. So in 2022/23, so from the table, is equal to 9.4 years, and I'm referring to the little blank that I left with the smiley face here. So here we take basically the company's current share price and we divide it by the earnings per share. So it's price earnings ratio, so price divided by the ratio. So again, in the name of the ratio lies the formula to this ratio. So we take the price for that year and the earning, so we go a bit up. Actually, for this, I will do it like that. I found the ultimate system to do it in a nice way, so like everything is in one place. So here you have the closing price, and here they have the earnings per share. And by dividing the two, you get P ratio. So those ratios for the price shares are written in a sentence, not in a little box formula. You still have to know them. The number, and the statement is actually a bit tricky. So the number of shares outstanding is more than 30 million in all 4 time periods mentioned in the table. Fun fact, number of shares outstanding is always the same. That's what you initially went to the market for, and you kind of sold. This is the usual case, right? Of course, there are some legal things that you can do. Let's say when you can redeem the shares, blah, blah, blah. There's a lot of complications to this, but the simple scenario that you're supposed to know because you're just starting your economic journey is this. You have the shares, the company issues them, that's it, case closed. And they're actually the same in every year. And how do you figure it out from the tables? Because you don't have those numbers in the tables given to you. And you need to know what market capitalization is. So I'm coming back to market cap that we discussed. So it's the shares currently held by all the shareholders multiplied by the current market share price. And if you want to reverse it and find the actual shares that are there, you say, okay, you just reverse the formula and you solve for this part. So this part is just market capitalization divided by this part. That's how you arrange the formula to get what you want. Any year that you pick, you will get more or less the same result because, of course, here they round up these numbers, the big ones. And that's why the numbers differ a bit, but I made sure that this statement will be true for any number that you pick. But they're actually the same, exactly the same if you actually know the exact number or market cap. So let's say we pick any, let's call this twice on the table. Let's say 2022, 2023. So here you have the market cap. And here you have the share price. By knowing this, the market cap divided by the share price for that year. Like that. Also for any year that was prior to that or after that, they're also the same. I checked. And yeah, it's always say the same. That's why the trick here is knowing that the number of shares is always the same and just taking 1 year to calculate, because if you do this, you are wasting time, essentially. So sometimes it's not the case, right? And you have to actually calculate all 4 periods for different ratios that are different each year. But this specific one is going to stay the same throughout, and you have to know that. And with knowing that, you just pick 1 year, you calculate the number of shares, and you're done. Then when dividends are equal to 0, that means that the earnings per share are 0. First of all, two different concepts. In case you didn't know, I will tell you now. And also, in case you don't know that there are two different concepts and you're kind of confused, you can always look at the table and say, hey, here, for example, since it's a real example, you have dividend per share being 0, and the earnings per share were not 0. So you can say, okay, since in this year, for example, there is a case where dividends are 0 and earnings per share are not 0. Therefore, this statement is very, very likely to be false because I have an example in front of my eyes given to me in the task that says otherwise. So it's false. And the actual definition, how you would approach it scientifically, would be earnings per share. Of course, there are different formulas for that. If you Google it, you could have like 5 different variations of it. But basically, it's the profit of the company that can go towards the shareholders, like what they have left to pay the shareholders, divided by the number of shares that are outstanding. So it's the idea. So it's what shareholders could potentially get per share that they owe. But dividends is what actually the company decides to pay in the end, because the company can not pay any dividends and it's going to be fine. Of course, if you have a large shareholder who owes 60% of the company and they have voting power, if you're the manager, they can also vote you and fire you as the manager. So it would be in your best interest to pay that shareholder some dividends, because if you don't pay the dividends and you don't, as they say, maximize shareholder value, those shareholders can fire you because they have the voting rights. So yes. Then here for statement E, the dividend yield in 2022/23 was lower than the dividend yield 2021/22. So here a bit annoying, but you have to do it for 2 years. So like 2 calculations. And then dividend yield from the book, it's basically the dividend in relation to the share price. So you take the dividends that you got in those years and divide them by the share price in those years. And from the tables, these are these ones. So you will be dealing with, these are the share prices, and these are the dividends that the company ended up paying. So they decided to, because they, well, they decided to pay in the end, what they actually decided to pay in the end. Not what they could have paid, but what they actually decided to pay. And that's how you get a dividend yield, and that's why I also kind of wrote a blank so that you have to calculate it yourself. And so this is approximately right. As long as it's, you don't have to get the exact number out. If this, you know that this is clearly lower than this one, then it's true. This will be the solutions. So yeah, this brings us to the end of this video. I hope you enjoyed it, and I hope now you have a bit of a better understanding of what is the economics part. If you like this video, please like it, share it with your friends, and comment below. So based on your activity, if I see that you really like these kind of videos, I'll also make more of those. So yeah, thank you so much for watching, and see you next ones. Bye bye.